In this presentation, you will learn issue of shares at premium. Issue of shares at a premium. When issue price of share is more than the face value of shares, the shares are said to have been issued at a premium. For example, if issue price is 110 and face value of share is rupees 100, then 10 rupees extra that the company collects is called as premium amount. There is no restriction on how much amount a company can collect by way of premium. However, there is a restriction on utilization of the premium amount. Share premium amount can be utilized only for the purposes mentioned under Section 78 of the Indian Companies Act of 1950. When companies sell shares at a premium, the amount of share premium so collected must be transferred to a separate account called securities premium account. The premium amount so collected is a capital profit. It is not a revenue profit, and therefore it cannot be utilized for payment of dividend. Being a capital profit, it can be utilized only for the purposes mentioned under Section 78 of Companies Act of 1956. Now let us learn the provisions of Section 78. The premium amount can be utilized for issuing fully paid bonus shares. It can be utilized for writing off preliminary expenses. Preliminary expenses are the expenses incurred by the company during the company formation period. For example, expenses of registration, expenses of printing memorandum and articles of association, etc. are called preliminary expenses. Share premium amount can be used for writing off expenses on issue or commission paid or discount allowed on issue of shares or on debentures. Premium amount can be utilized to provide premium payable on redemption of redeemable preference shares or redemption of debentures. If the company wants to utilize the premium amount for any purposes other than the purposes mentioned in point number 1 to 4 above, then court sanction is needed. The balance of security premium account should be shown separately on the liability side of the balance sheet under the heading Reserves and Surplus. Now let us understand the journal entries that are passed for the purpose of recording issue of shares at a premium. Company can collect the premium amount either at application or at allotment or at call stage. If it is collected along with application, following journal entries are passed. Bank account debit, say rupees 110, to equity share application, say rupees 110. Then this amount of share premium is transferred to security premium account with the following journal entry: equity share application account debit 110, to equity share capital 100, and to security premium 10 rupees. If premium amount is collected along with call money, then following journal entry is passed: equity share call account debit, say rupees 110, to equity share capital, say rupees 100, to security premium, that is rupees 10. Remember that unless given otherwise in the problem, the security premium is assumed to have been collected at allotment stage, and we pass the following journal entry for that: equity share allotment account debit, say rupees 110, to equity share capital rupees 100, and to security premium account rupees 10. Thank you friends. Here ends the second part. In the next presentation, you will learn about issue of shares at discount.